Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Happy May 20th, what people call, Viente y Mayo. Hello, everyone. It's Peter Dunn, CEO of Your Moneyline, here at 2 p.m. Eastern, as I am every Tuesday and Thursday, for 10 minutes, just 10 minutes, 600 seconds of you and me, where we talk about one element of the economy, one element of the market, and one element of your personal finances until things calm down a little bit. Since April 2nd, things have been a little hairy in the economy, in the market, and arguably your personal economy. And so that's why we gather here today. Since we last spoke, the market is on a hot streak. Now, not super hot. It hasn't lost now in 6 sessions. Just so you know, a session is a day of trading. They could just say a day of trading, but people say session to make themselves feel cooler. Anyway, there's a 6-session winning streak, but it looks to be broken later today. Market closes in just under 2 hours. It looks as though the market's going to have a little negativity there. The biggest piece of news before we get to our 3 items today to take away is the CEO of JP Morgan, Jamie Dimon, suggests that the market is not taking into consideration the risk of stagflation. Now, we've talked about stagflation. I know you've missed an episode. Stagflation is when the economy is stagnant, it is not growing, and inflation takes hold. That is called stagflation. That is a bad thing. It is a rare thing. It is also a bad thing. So Jamie Dimon says the market is not accounting for that enough, and he thinks there's some crisis on the horizon. Alas, let's move on. Here's what we're talking about today. We're going to learn a little bit about ETFs, the difference between those and mutual funds. We're going to talk about core inflation, which is a little bit different than the normal inflation we talk about. Interesting. And of course, variable and fixed expenses in your own personal finances. Hey, you could teach me about those. That's pretty basic stuff. Important to know nonetheless. Let's get started. Let's start with ETFs and mutual funds. For those that don't know, let's start with mutual fund. Mutual fund is a basket of, in many cases, equities, a basket of securities. So it's just a bunch of stocks that are all within what we'll call just one portfolio, a bunch of stocks all owned by this one portfolio, all this one fund. And when you buy a mutual fund, you instantly diversify your holdings and you own all pieces of all the stocks that are in that particular portfolio. It is a diversification technique. If you had $100,000 to invest, why did I choose $100,000? I don't know. Let's go with $50. Let's say you had $50 to invest, and you could either buy stock A or mutual fund B. And mutual fund B actually had 300 stocks in it. They were both just $50. You would, if you want diversification, you would go the route of the mutual fund, and then you've diversified your risk. Because otherwise, if the stock just goes down, in the single stock, then you got a lot of risk there. If that same single stock, if it existed in that portfolio of hundreds, went down, it really wouldn't matter because there's a lot of other things going up and down at the same time. Now, there's something similar to a mutual fund. It's called an ETF, and essentially it's an exchange-traded fund. They're very similar, but there's some key differences, so let's tackle those key differences. Okay, so a mutual fund, at the end of the trading day, which is 4 p.m. Eastern, the end of the day, all of the stocks either went up or down within the portfolio, and at the closing mark, that's how the mutual fund is priced for that day. So all these things are going on intraday. Let's say there's 400 securities. They're all going up and down and up and down and up and down. At no point in time does the mutual fund say, the value is this right now. It doesn't do that. It only prices at the end of the day at 400. So if something's going on major in the economy midday before the market closes and you want to get out or you want to get in and you have a mutual fund, whatever happens in the rest of the day has to happen before your transaction can actually take place. So that's pretty interesting. An ETF, which is, again, a basket of stocks, it can be bought and sold all day long, just like a stock. You could buy and sell intrasecond if you really wanted to. Typically, the fees on a ETF, an exchange-traded fund, are lower than those of a mutual fund. Now, I don't think we've talked about active and passive yet, but passive is when a group of funds just sits there, no fund manager is buying and selling them and taking them out of the portfolio for your benefit. That is called a passive portfolio. An actively managed portfolio is where this group of stocks exists. And sure, you're just investing in the fund, but there's a portfolio manager that's removing and replacing things within the fund all the time. That's called active management. That's a more expensive thing because you got to pay for research and humans and those sorts of things. So typically, most ETFs are passive investments. Some mutual funds are passive investments, but more of them are active. Let's talk about tax efficiency. ETFs are more tax efficient because of something called in-kind creation and redemption. So that's important to know. And oftentimes, if you hold a mutual fund and it is not in a retirement plan, you're more likely to have capital gains. So if it's an active fund and people are buying and selling throughout the year, that generates gains and losses, and you have to pay taxes on that if it's in a non-qualified investment. Minimum investment on a ETF is super low. I mean, just buying one share of it. Typically, with a mutual fund, there is a fund minimum, so it's easier to get into ETFs. And then finally, it's just less expensive from a trading perspective. You're going to buy and trade and do all these different things with your funds. It's cheaper to do it with an ETF. That's all you need to know. Talk to your financial advisor. Let's talk core inflation. We talk inflation a lot on this show, but core inflation is something a little bit different. What it does is it takes annual consumer prices, excludes volatile items specifically like food and energy that can just fly up and down. Remember all the conversations about eggs? And there's always conversations about oil and fuel prices. So this just sort of normalizes it a little bit. So let's just walk through. We'll go back to November, election month, what core inflation rate was in the United States. It was 3.3%. December, it ticked down to 3.2, went up a little bit in January to 3.3, February 3.1, and then down to 2.8 in March and 2.8 again in April. That's the lowest level it's been in some time, that 2.8%, which is great. Last time it was that low, looks like March of 2021. So that's to say, from that perspective, core inflation, things are looking okay. Right now, as the Fed tries to make decisions about whether they need to intervene or not, they're looking at things like core inflation. My gut tells me it's going to go up a little bit, but we'll see. We'll see. That's the nature of just waiting and seeing, but I think it will. Finally, personal finance concept of the day, variable and fixed expenses. Okay, so if your fixed expenses are your bills that do not go up and down, maybe your mortgage payment, maybe a car payment, maybe a student loan payment, those are fixed. Your subscriptions, even though they tend to go up all the time, your subscriptions are fixed. It's basically the same amount every month. Even your utilities, if you are in what we call budget billing, where you just say, hey, charge me the same amount every month, we'll figure out the difference later, that is a fixed expense. Typically, it's a lot easier to manage your money when you got fixed expenses. There's no guessing, there's no overage, it just is what it is. A variable expense, as you know, is the one that changes from month to month, week to week, over time. And there are also categories like that, right? Food is the biggest variable expense that can possibly exist. Fuel, which we just talked about, which is why they're removed from core inflation, because they are so variable in nature. If you are trying to cut your spending, it's really, really important. If you're trying to budget, if you're trying to get out of debt, trying to create a little bit of emergency fund, first, when you look at your spending, separate them into two categories, fixed and variable. With the fixed one, typically what you're trying to do is you're trying to cut the expense altogether, cancel this subscription. With variable, what you're trying to do is to reduce the amount you spend in that given period of time, change your habit so you can take advantage and then accomplish whatever goal it is, saving for something, whether it be an emergency fund or even paying down debt. This has been lucky episode 13 of the show. We are going 20 episodes. We are going through June 12th here on the show. Oh boy, do I have a new one for you on Thursday. We're doing short selling. This just got advanced. We're doing short selling. We're talking about the yield curve, which not a lot of people understand. If I teach you about a yield curve, your coolness factor just went way up. And then rebalancing. That's all on the next
CalmCast.
I'm Peter Dunn, and we'll see you on Thursday.